We're in an interesting time where we have prolonged high interest rates, and it looks like this is a new normal. Historically, they're not that high, but they're higher than we've seen in a long time. How's that going to affect you and your portfolio? Hello, my name is Paul Carroll, the CEO and founder of Avion Wealth, an elite wealth management firm here in Texas. Despite a lack of rate hikes by the Fed, in fact, if anything, the periodic cuts, 10-year treasuries are flirting with 5%. Long bonds are already past 5%. This is a new normal that's going to change how we look at investments going forward. Why are we seeing these long bonds going up while the short-term rates are still low? There are a number of reasons for these rising long-term rates. First and foremost, we have a strong economy. Second, the thing to keep in mind is this is a global phenomenon. Third, there are fears of rising inflation or continued inflation. And when I say rising, I don't mean rising to 6, 7, 8%. I'm saying it looks like they're going to get sticky around the 3% area, much as we've talked about many times in the last few years. Why? Well, there's a number. If any of the tariffs come through, tariffs feed directly into inflation. We have a strong dollar. That increases the cost of imports. We have labor shortages that are throughout the Western world, and if the administration follows through on its deportation policies, those labor shortages are going to get even worse. And then we have a sense of uncertainty in the system, primarily due to fiscal irresponsibility throughout the Western world. Populations are getting older. Older people like their money being spent on them. They're also the leading cause of the deficit. You can't cut taxes and not cut Social Security or Medicare. And no one, blue or red, has the stones to do that. So we're looking this year at the U.S. issuing bonds at the rate of 7% of the GDP. And last but not least, we're in an era of increasing global uncertainty. There's a lot of populism throughout the world, a lot of rash statements being made by a number of global leaders. And global uncertainty leads to higher long bond yields. Why? People want to know they're going to get their money back in 20, 30 years. So how's this going to impact us? First and foremost, we have mortgage rates sticky at 7%. I'm not predicting they're going to go up significantly, but this completely changes the pricing and valuation of real estate stock throughout the U.S. and even throughout the world. Reducing the demand for real estate reduces the demand for construction, for home improvement, for all the appliances that go into new houses. It's going to be a speed break on the economic growth. Another area is corporate debt. Corporations, especially BBB and junk-rated companies, have really gorged on cheap debt. That debt matures and now has to get refinanced at corporate rates that are significantly above that 5% point. That's going to put a strain on companies, and we've talked about zombie companies before. We're going to see zombie companies go out of business. And the biggest risk from an investment point of view is the stock market. The stock market depends on low interest rates for high valuations. The S&P dividend yield is right now at 1.285%. Well, when you can go to short-term treasuries at almost 4 or 5%, 10-year treasuries at almost 5%, long treasuries at even more than that, that yield really hurts the valuation case for stocks. So how does this affect you? If, like many investors since 2022, you've really enjoyed this run-up in the stock market, with the price-earnings ratios at close to 30, which is historic highs, and now attractive alternatives, it puts the equity markets in increasingly unsteady territory. Don't forget to rebalance. That's the point of an asset allocation, is to make sure you've got chips on the table so that you've got chips should the market fall. We wish you the best of investing success. Please call me if you have any questions. Thank you.